Hi friends. As we encounter changes and turbulence in financial markets, regulation, and the introduction of new business models, it's important to step back and see that have we missed an opportunity? Let me draw your attention to the size of the deposit pool as compared to mutual funds, shares, and debenture holdings in India. Flows into deposits are 3 times larger than the flows into mutual funds, shares, and debentures put together. Moreover, the deposit pool in India is 11 times larger than the mutual fund debt pool. This clearly indicates that we have not been able to understand how can we make better investments through debt mutual funds. Now, the common question that I come across when I meet people is, how do we make sense of the different debt fund categories that exist in the market? They wish there was an easy and intuitive way for people to classify funds as per their investors' needs. So let's see, what do investors really need from their fixed income investments? They need 1. Predictability of returns. 2. An ability to call their deposits when the need arises. And for customers who are looking for investments into debentures, they need that extra return over and above their fixed deposit investments. So let me introduce you to a framework, which helps make sense of what investors really need and what debt mutual funds have to offer. To help you understand how to allocate your money across the debt fund spectrum, let us look at our investments through 3 lenses: liquidity, core, and satellite. Let us take a minute to understand what these terms really mean and what investments really fit under each of these buckets. As far as the liquidity bucket is concerned, this is there to provide for predictable and unpredictable needs that may arise in a customer's life. And therefore, products such as the liquid fund and the overnight fund are suitable. They give customers an access to their money whenever the need arises. In the case of the second bucket or the core bucket, this is really to take care of the core fixed deposit investments that an investor may have. And therefore, these investments control the duration as per the investor's needs, as well as minimize the credit risk so that the core needs of safety which a customer really comes into for fixed deposits are not compromised. The funds that really fit into the core bucket are funds like the ultra short term fund, low duration funds, short term funds, medium term funds, the corporate bond fund, the PSU and banking debt fund. Some fund houses could be introducing higher risk through higher credit paper in the core bucket. But this framework encourages investors to stay away from higher credit in the core bucket because there is a special place for that, and that lies in the satellite bucket. For customers who are looking for that extra return over and above their fixed deposit, the products in the satellite bucket are a good option. These products take on higher duration risk and higher credit risk so that customers can make that little bit extra return. The products that fit under the satellite bucket include funds like the medium to long bond funds, the dynamic bond fund, the government securities fund, and credit funds. So, how should one really allocate between these 3 buckets? After putting aside money for an investor's liquidity needs, we should allocate our money in the core and satellite buckets as per the investment horizon and the risk appetite of an investor. It is recommended that we make a higher allocation of money to the core bucket as part of investing in a fixed income portfolio. This framework is a great way of allocating money across debt funds. It takes into account the needs that investors have from debt instruments, as well as helps investors to allocate their savings from the traditional deposit pool to the debt fund pool. Quite a spectacle, what do you say? Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.